All right, well, good morning. My name is Justin Benavidez. I'm the district economist for Texas A&M AgriLife Extension in Amarillo. I've met a lot of you in the room before. Some of you are some new faces. Please come back and visit us here at the back table if y'all have some time after the presentation. We've got a lot of things to talk about this morning. We're going to cover a variety of different topics, but I will say that last night at dinner, a little bit after dinner, Ron Gill was saying he didn't like as many tables and numbers and just data being thrown at you. So what I'm going to tell you is that if there's a few takeaways from this presentation, he wanted movement as well, some interpretive dance style stuff. So grain is going to be down this year is one big takeaway. Both feeder and fed cattle prices are going to be up this year, which is another big takeaway. And so the question is, with one thing going down and one thing going up, where's the best place to direct our assets, direct our time, and direct our cattle if we have the opportunity to place on feed or the opportunity to keep them on pasture? Because this question of retained ownership and feed costs, we don't want to just put cattle where we will make money. We want to take advantage of these opportunities where we can make the most money, right? So as an economist, we want to focus on things like rates of change and a bunch of different factors that show us where the most value can be squeezed out of the assets that we have in a limited amount of time. Because as we all know, even though cattle prices are going up now and grain prices are being pressured downward now, that won't be the case forever. So talk about a couple of different things this morning to look at this entire picture. Again, grain market outlook, grain going down. Evaluate retained ownership and the possibilities for profits in that system. Again, cattle prices largely going up. Then we want to talk about some other opportunities in risk management. So things to think about. As economists, we're traditionally, most of us are more of the planning type, right? And sometimes we suffer from a lack of execution, but we're largely planners. And so what we want to think about going forward is, in terms of other opportunities in risk management, let's just think about our entire beef system, our entire cattle production system, not just the calves we have for sale this year, but the calves that we need to sell next year, those really expensive heifer replacements we were just talking about. What do we need to make those heifers successful? Is the grass that we have available in a limited quantity this year a better financial tool for the calves that we are growing right now? Or do we need to reserve and rest some of those pasture in the planning for having valuable heifers on pasture in the near future? There's a lot of these different things that we need to consider when evaluating any marketing move, including retained ownership. So we'll go through several of these things. I'll try not to belabor the grain market outlook too much, but it is important when we think about where the entire fed cattle retained ownership, or just the fed cattle feeding sector, is going, because obviously it's a major input behind the price of purchasing that calf. It's the most expensive part of cattle feeding. So thinking about where the grain market outlook is going, we always like to start with, on an outlook, the demand side, where we like to think about demand and supply. Economics is very simple, though my profession has a tendency to complicate it, right? Demand for grain going up over time, so going up that way, right, up and to the left. Demand here is largely being driven over time by emerging economies, and so as much as many of us are watching the news and seeing that China is suffering in some kind of recession over the last year and potentially in the next 2 or 3 years, and thinking that's largely a good thing, China is a major demander of most of our agricultural commodities, right? There are a bunch of stomachs in China that need to be fed, and in many ways, they are driving this increase in grain prices over the last, 20 years. Now, I know for many of us, this is a negative as we place cattle on feed, but if we also grow any grain, any of our own feedstuffs and inputs, it does make some of that a competitive option that we also want to think about in terms of, well, is it worth selling some of my own commodity? So different things to consider, but in general, the demand for grain is largely driven by consumption in developing countries. So we call these our BRIC nations: Brazil, Russia, India, and China. And over the last 20 years, as many of those countries have moved out of severe poverty and many of them have moved into the middle class, it's coupled very tightly with grain use, and we know as use of a commodity goes up, demand is going up. That means that all else equal, price will also increase. So over time, we expect that price of grain to moderately continue to increase. The only thing that might moderate that increase in the upcoming year is that potential recession in China, right? And so thinking about what happens in China in the next 6 to 8 to 12 months, if they have a severe recession and their demand for grain goes down, the one limiting factor there is their demand for proteins probably also in an associated way gone down, because much of their grain use is in feed for their protein. And so we also want to think about, where does this economic activity in terms of recession drive not only demand for grain but demand for protein. But in general, what we see here on the demand side, over time we expect the price of grain to slightly increase year to year as consumption and demand goes up. But in general, over the upcoming year, we expect those prices to pressure downward just slightly. Where did we start the year at? So this is Texas weekly cash price for corn, sorghum, and wheat. This is an aggregation of the north of the Canadian triangle from area, this is north of the Canadian River, and then the triangle from Plainview Canyon to Farwell, and then south of our line from Plainview to Muleshoe. We've got our corn price in black, our sorghum price in green, and our wheat price in red. You know, back when I started in 2019, we were in a feed wheat market. Feed was a competitive input in many cases in terms of being a feedstuff rather than a foodstuff. We have now seen, obviously, the price of wheat has skyrocketed, largely as a result of that Russian invasion of Ukraine. We had moved into a pretty stagnant, if we went back a little bit further, grain market where prices were pretty flat over time. But as we moved through the 2020 period, we saw some increasing pressures on the entire grain production complex, from that derecho where it leveled a lot of the grain crop in the Midwest, Brazilian drought at the same time, and then Chinese feed grade demand, again, as a function of two different things: rebuilding that hog herd that had been decimated by African swine fever, and the need to increase that protein source, coupled with the second factor, which was attempts to comply with our Phase 1 agreements for the U.S.-China trade agreement. So all of that slowly began to support prices in an upward fashion. We see that wheat broke away from the pack right here, and what was happening there is that we had some struggles in wheat-producing countries around the world, not only the United States, but Russia and Ukraine in particular saw some severe challenges in wheat production. And then we move into the beginning of 2022, and Russia invades Ukraine on February 24th, and overnight we saw an increase in the price of all of our feed grains. So actually, we would have said that last year was probably, when we were in January of 2022, we would have, as a group of livestock economists, thought that 2022 was going to be a year worth considering retaining ownership, because there would probably be some profits in the cattle feeding sector. Obviously, a lot of that strength was liquidated when all of these commodity prices went through the roof. And so if you were to look back at feeder cattle prices right around this time, they were all pressured downward as well, because in an attempt to maintain margins, obviously cattle feeders have to bid a little bit less on calves if they don't have as much control over what they're feeding, or if feed prices get a little more expensive. But in terms of cash right now, we are sitting at $8.25 per bushel on wheat, $7.72 for corn, and $6.87 for sorghum. This is all delivery here on the Texas High Plains across a vast range. So keep in mind that this is probably a little low in some cases here on the Southern Plains, because we're incorporating prices that are also north of the Canadian. So we're probably a little bit low in some of these cases. What in turn is going to drive the prices for the upcoming year? It's all supply and demand. Again, think back to, we have demand which might be pressured a little bit in terms of some recession activity, though a lot of those discussions on recession are that the recession might not be as significant as we thought at the end of last year. So now we want to turn to the production side of this equation. We think about world corn production. If production is going down, which we forecasted a final crop being lower in the current crop year, so when we think about the production year versus the marketing year, we are moving into the marketing year for last year's corn crop. This is the production year that we just basically ended in harvest of December. All the reports kind of, make it a little bit staggered, where that first production year for 23-24 is going to happen in May, but we've essentially harvested the corn that we're going to harvest at this point. The forecast production for this year is down, and so we see that some loss in corn production is going to support prices, which is why over the last 6 months we've seen, again, thinking back to corn price, we didn't fall back below to these $4 a bushel values that we had for corn back in 2020. There's a little bit of a gap in the corn market right here that's supporting prices, as well as sorghum and wheat prices. We lost some production. What is that going to do over time? We expect that as production goes down, right, we've all harvested our corn now. We know we have a little bit less production. We expect that this is going to support prices through the remainder of this year, and as prices remain a little bit higher this year than what the market is dictating in terms of what we need on the marketplace, we're going to see some more corn acres come online. And what that's going to do is into the next year, we think, continue to pressure some of those corn prices down from where we are right now. And so basically we're looking at range-bound trading into the next 6 months on corn. I wouldn't expect big moves one way or the other on corn prices. And when we think about this on our planning stages here in a few minutes on retained ownership, we're probably looking, because of this force, at pretty range-bound trading on corn all the way out to well past planting and probably at least to the June acreage report. Thinking briefly back to China in terms of our feed grains, so thinking about corn and sorghum, and not necessarily wheat, but certainly corn and sorghum, we saw that over the last 3 years, China entered the marketplace for, in particular, corn, and for our purposes here on the Southern Plains, sorghum in a big way. So in an attempt again to rebuild that hog herd, as well as to comply with phase 1 agreements between China and the United States, they entered the marketplace and were pulling in millions of metric tons more than they historically have pulled in, right? So we saw a doubling in total imports of Chinese feed grains, or excuse me, of China's importing of feed grains, basically from year to year. Now that has slowed down over time, and we expect that trend to continue to moderate again on some of those recessionary activities, as well as their hog herd has largely completely rebounded and their stocks are getting closer to rebuilt. So this means pressure downward on prices, which for the cattle feeding industry is a good thing, as we expect that cost of gain to begin to moderate and get even lower. Principles that are really important for the corn market. This is something, maybe a takeaway if you want to watch the different marketing reports in the future and plan your own hedging and risk management. We'll talk about some of those risk management tools here at the end, but you want to think about your risk management opportunities. Anytime that we see corn days of use on hand below 40, so if we have the amount that we use in a given day versus the amount of total stocks we have available, anytime that that ratio is below 40 days of use on hand, we see what I call biofuel era prices. So we think back to the late 2000s and the early 2010s, we had less than 40 days of use available in our complete United States stocks, which is that blue bar right there. What that means is that we kind of have a hard time getting corn from where it's relative price. Does this make me louder or makes y'all hear me back there? Okay. So, again, this is good news for us in the cattle feeding sector, right? We expect to see that over the next 12 months, and if you look at the board, we do see some pressure downward in corn price. Thinking again about wheat production, just in terms of where we expect wheat price to go, we're not moving back into a feed wheat market in terms of its relative price strength when compared to corn. Wheat stocks and wheat production has stayed flat. Days of use on hand, the principal here is right around 124 days. We are low. That kept wheat prices high this year. What that means is that we expect more wheat acres in the upcoming production year. That's going to pressure total price down as supply goes up. So we expect to see more spring wheat acres up in the part of the country where we grow spring wheat as opposed to the winter wheat crop that's really facing all those moisture struggles here on the southern plains. Season average forecast for the upcoming year, $8 a bushel when compared to $9.20 in the previous crop year. That's not low enough really to make us think about being a feed wheat market. Just thinking about our alternatives in terms of pricing whenever we're looking at that retained ownership option. So grain market takeaways again. Grain acres for our feed grain up means price down, right? So we expect to see pressure downward on prices into the next 6, if not 12, 24 months, depending on where that acreage finally shakes out. Corn wheat acres up. Stocks to use ratio indicates lower prices. I say moderately lower. I know that $8 wheat and $5.70 corn does not sound like cheap grain for those of us feeding cattle, but it is moderately lower compared to previous years. Things for all of you to watch and think about when you've got cattle on feed. We want to be sure that we're marketing. Did it work? Okay, we'll stop. I'll stop yelling. Yeah, sorry. So we want to think about into the upcoming year, obviously, if we're marketing our own commodities, so we're thinking about buying grain, hedging grain, because we're in such a range-bound trading environment where there's not a whole lot that's driving price higher, not a whole lot that's driving price lower, we want to watch for shocks overnight that might push grain down lower, so an unexpectedly large acreage report, or we want to watch for reports that we think are going to push grain higher. So any other geopolitical stressors on the international stage that might impact our grain producing countries and therefore drive grain prices higher. That will be time to price something in a little bit cheaper. So now that we have our major input, or our second major input I should say, other than our feeder calves, we think about grain prices going down. On its own, that would suggest that we are probably looking at a more favorable environment for feeding cattle, retaining ownership. So we want to think about going forward now is how to evaluate that decision into 2023 and 24. Now I'm going to tell you right offhand, I'm not an expert at retained ownership. Working on a bunch of programs to grow that part of our curriculum here in the High Plains. I'm working with Jason on a lot of that information. But what we know is how to evaluate these decisions critically, right? And to think about not just the immediate future and what that means for retaining ownership this year, but for our beef cattle herd back home off of the yard into the next year or two. We want to think about a lot of those things as we go forward. So economic measures to consider: feeder cattle price, again, up this year. Fed cattle price, also up. What's driving that? Daryl said yesterday, we have low inventories. We have some of the historically lowest inventories we've seen in a very long time. We want to think then, if those prices are changing, how do they impact our value of gains? So sale price at the terminal stage versus purchase price, right? Or what we essentially are giving up in terms of selling that calf as a feeder animal. Then we want to compare that value of gain to cost of gain. Putting these four factors together, we can come up with what an expected outcome is for cattle feeding or retained ownership into the next year. We also want to think about this fifth component, that is alternative opportunities and risk management strategies. Now, risk management is a suite of tools that are both federally funded risk management insurance tools and disaster assistance tools, but it's also, again, thinking about production risk management. So a lot of those things that I know we've discussed over the last couple of days, But production risk management in terms of, again, with the limited grass that I have available and the knowledge that I'm going to need to replenish my cow herd and grow some more heifers, if not this year, in the next 2 years or 3 years, what's the best use of that grass? So is it better for me to retain ownership and rest some of my pastures by getting some of those calves off of that grass? Is it better to keep them on pasture, because gaining pounds on pasture right now is cheaper in many cases than placing them on feed? There's a lot of things to consider as this fifth component of the entire economic question. My rule of thumb, this is a graphic that's produced by LMIC. This is average returns to cattle feeders on a monthly basis, going all the way back to 2013. They have data prior to that. If this set of bars is on the negative side, I personally am not considering retaining ownership. If the professional cattle feeders who feed cattle 24/7, 365 are not making money, or even if they're close to neutral, I'm probably not going to consider retained ownership. And Jason has mentioned many times to me that, if you've got a system in place and it's a system where over time you mitigate your risk and you feed every single year and you've got a good relationship with your feeder, that it may still behoove you to maintain that system. But if you're considering this as a new entrant into this marketplace, or you do have flexibility in terms of retaining ownership or not retaining ownership, then whenever I'm looking at this graphic, if the professionals are tight on margins or losing, then I am going to not plan on retaining ownership of my own cattle, simply because I probably can't beat the professionals, right? And the professionals are going to be the ones that are feeding my calves for me anyways. The environment we see right now is not on the negative side. The decrease again in the price of grain, the increase in the price of calves, both on the feeder and the live side, suggests that average returns to cattle feeders are going up. And as Daryl said yesterday, I think we can expect some record-breaking prices. He didn't say a number, and I'm not foolish enough to say a number if Daryl won't say a number. But we do expect to see some record-breaking prices, even when adjusted for inflation over time. There's some record-breaking values of calves, both at the feeder and live stages. So let's think to those four components, and then we'll talk about that fifth one on its own later. But feeder cattle price being the first component, this is your alternative revenue outcome. So this is the thing that you can think about you're giving up whenever you choose to place cattle on feed, or opportunity cost, right? So you could sell at a 5-weight or a 6-weight or whatever it might be, 7-weight for you. This is a proxy for what you should sell your calf to yourself for. I'm always an advocate of, if you've got a cow-calf operation and you retain ownership, I'm a big fan of, even if you don't legally separate those entities on paper, that you mentally and in your record keeping separate those entities to know where you're making money and where you're losing money, right? So keep your records for your cow-calf operation, and on paper at least sell from your cow-calf operation to your cattle feeding operation to know where returns and losses are coming from. Even thinking about how important interest rates are in this year, right? If you've got a more favorable interest rate where you're feeding cattle versus where you're on your cow-calf operation, those are things to think about comparatively. But this is the base of your profitability calculation when retaining on feed. And we couple that together with our fed cattle price to calculate that value of gain. These are prices as of this morning. $1.86 in March. We're going to think about, for our example, here in a minute, placing a calf in March or April of this upcoming year, and then compare it to what that final value of gain is going to be. But these are prices as of this morning, the board right before I walked up here, as most recent as I could possibly get. Second component, again, thinking about that fed cattle price, retain ownership revenue stream, right? So this is the final outcome, the final calculation to base profitability on. We're going to couple that with feeder cattle price to calculate that value of gain. We can see again $1.60 in the immediate future. Some pressure through those doldrums, sort of through the middle of the summer, but then we again see in the fall, in that push for more fed cattle, we expect prices to go up over time. We expect this to approach, if not $1.90, then possibly even, I'll risk it and say I would not be shocked to see some single day trading approaching $2, depending on how tight we find this beef supply to eventually get. Well, over time, we want to compare rate of change in this set of contracts to rate of change in this set of contracts. And that's going to also help us understand where it's best to place those pounds or where to grow those pounds. So then again, I'm sure this equation is not new to most of you in the audience, but value of gain. So that March placement in this year at $1.86, assuming a 7.5 weight placement, $1,398, right? So if we're selling this animal from our cow-calf operation into our retained ownership operation, we're going to pay $1,398, or another way to look at it is we're giving this up in order to pursue the retained ownership marketplace, because we could sell right now for $1,398. That September sale, maybe October sale, we're looking at $1.63 at 1,300 pounds. Value generated at 2,119 dollars per head. And then to calculate expected value of gain, what we see is we've got final value minus present value, net of those pounds gained, to give us $131 per hundredweight in terms of value of gain per hundredweight, or $1.31 per pound. That's expected value of gain in the upcoming year, and you can lock that in today. And we'll talk about a risk management tool at the end of the presentation called LRP, and if you haven't considered using it before, that tool has become a lot more attractive, and so I'm telling you that you are able to lock this particular value in as we sit here today. Estimated cost of gain now. Again, I'm sure this is not anything new to many of you in the audience. We're going to use corn price as our proxy, as a rough estimation. I like to use corn price, and Jason has mentioned to me, obviously there are other components that go into cattle feeding that are not just corn. Corn is a ubiquitous contract that we can track with regularity and helps us really understand in terms of cost of gain over time what the trends look like, because we have so much data on what corn price looks like. So I like to use corn. You may have a more detailed equation, but what we're looking at here is $8.27 per bushel. So that's delivery, again, as of this morning in the Texas Panhandle. So an average across 3 regions from Lubbock all the way up to the Oklahoma border. $8.27 per bushel delivered, includes that $1.50 basis that we expect. Divided by 56 pounds per bushel, we're assuming 6.1 pounds of gain. Excuse me, we wish, right? 6.1 pounds of feed per pound of gain to give us about a 91 cent per pound feed cost of gain. So price of corn converted into our cost per pound, estimated feed to gain ratio. Then what we look at down here, we're assuming about an average of 1.33 times feed cost of gain to account for non-feed costs, so markup, yardage, that type of thing. So multiply 1.33. I've left this number the wrong way. I'm sorry. This should be 91 cents per pound. I didn't get that changed. But we come out to anywhere from $1.20 to $1.25 per pound. So think back then again to value of gain. That's going to be important here in a second, versus our cost of gain, $1.20. But we don't just want to think about what corn costs us today. We need to think about what corn is going to cost us for the remainder of the year, right? We're not just feeding cattle today, we're feeding cattle for the next year. So here's our board price as of this morning, plus an assumed basis of $1.50. That fluctuates as well. We've got tools that you can use to mitigate your basis risk. Feed cost of gain, calculated in the same way that we calculated this. And our total cost of gain that includes that 1.33 markup. On average, for the next year and a half, we expect cost of gain per pound to be in the neighborhood of $1.13. When I use this chart and put all this together, again thinking about our risk management side as we approach the end of the presentation and what our risk management options are, plug in $7 here, plug in $7.50 here, plug in different values across the board and evaluate what your outcomes are if that cost of gain changes over time. What can you afford? What's the maximum you can afford, and where do you need to start thinking about pricing if prices are going up, right? I like to evaluate a bunch of different possibilities through time. So putting it all together, we've got our value of gain again from 3 slides earlier, $1.31 per pound, or $131 per hundredweight. That's our value of gain. Cost of gain, about $1.20 per pound. So economically speaking, we would say value of gain greater than cost of gain. We're off to the races. This guy's a professional. Please don't go hop on a bull this afternoon. Value of gain, though, higher than cost of gain. There are a lot of things to think about, economically speaking, that are important for this decision that are not simply 131 per pound is greater than 120 per pound. And we want to think about this in a holistic sense, but if your entire decision-making process is, am I making more money in the yard than what I'm spending to make those pounds, so marginal revenue is greater than marginal cost, then in the upcoming year, our forecast suggests that you will make money on retained ownership. There's a lot of things that go into this. Obviously, we need to factor in some death loss costs. We need to factor in some other aspects that are not included here in that cost of gain calculation necessarily, but in general, it is a more favorable retained ownership environment this year than in the previous year. So what are some of those other considerations and opportunities? Don't forget to evaluate your cost of gain on pasture versus your cost of gain on feed. So does it make sense for you to add those pounds on pasture versus adding them in the yard? If you've got pasture available, right? We know that this year there is a lot of pressure on forage availability, not just in Texas, not just in the high plains, but across the West. Not just in New Mexico, but across the entire western United States. So if you've got pasture in general, what we want to evaluate is is it cheaper for me to place or to add weight on pasture than on feed? And if so, how bad is the slide whenever we're considering selling a 5-weight versus a 7-weight? And do I lose some potential gains by placing a heavier calf? Or is it realistically more valuable for me to put those pounds on pasture versus on feed because the cost of feed is outpacing the cost of placing those pounds on pasture? You want to pay attention to that rate of change in feeder versus live contract right now. If we think back to what our prices were, the change in the value of feeders over the next 12 months is outpacing the change in the value of the live contract, right? So in some cases too, thinking about where can you gain some of those time values is important as well. Just having that calf in your own possession for time is going to be a value that you add to the marketplace in addition to just the pounds added on cheaper pasture. What do we do with the grass that we have? We're not just evaluating retained ownership in a vacuum. We need that pasture for all of our cattle. So is it important? Is it a better financial decision long-term to maintain those growing fed calves? Or should we save and rest some of that pasture for the replacements that we're all deep down really considering, right? Someone in this room, I hope not, but I'm guessing someone in this room is going to buy a replacement heifer in the next 2 years that they really can't afford. I'm just guessing, right? So when you buy that heifer, is it important that you have enough forage for her? I think the answer is yes. If you're already in a deficit forage situation, but you're wanting to regrow that herd, was it better for you to maintain these calves on pasture to get cheaper gains in 2023 and therefore a bigger paycheck in 2023? Or did you need a better forage base for the cattle that we retained for a longer period to give them a better start, maybe not miss one of those breedings, having them in better condition? In general, the point here being, I don't want you to think about retained ownership in a vacuum or maintaining on pasture in a vacuum. There might be some other uses for your inputs that you should consider. And again, compare that cost of gain relative to the value of gain. What we just looked at is that essentially the opportunity this year on average looks to be somewhere in the neighborhood of 11 cents per pound, I think, if I've got my numbers right on the top of my head. We had, $1.31 versus $1.20 in terms of cost. You might have a tighter margin. If you're facing a nickel return per pound, is it worth your time and your risk exposure? And with that in mind, what can we lock in today? What risk management can we use to say, all right, a nickel is enough for me per pound. I want to make sure that I lock that nickel in though, and I'm not pushed down to a penny or a negative return because of some unforeseen circumstances. Some of the pressures on retained ownership are certainly forage and feed costs. This is our pasture and range condition that ended its reporting in October. We see that percent rated poor and very poor is high on the southern plains, higher than the historic average by quite a bit. Forage and feed costs, when we're thinking about retaining on pasture as an option, we've gone from about $110 a ton, and this is an average of 5 different types of hay priced here in the Texas High Plains. Gone from about $110 a ton all the way up to $345 a ton in just 2 years. Hay stocks remain pressured and down, if anything, and so we don't expect that price to get any lower. So this goes back to that decision of, if you're going to maintain those calves on pasture, you're probably going to have to feed some hay based on these two graphics, right? We think about percent poor and very poor being high. We also know that hay price is high. If you're going to have to add pounds here, we want to make sure and calculate how much does the added pound cost us on pasture versus on feed. In general, if you've got pasture, we would think it's cheaper, but if you're going to have to add some supplementation, it may be more expensive actually to place them, to keep them on pasture than placing them on feed. Now finally, risk management tools. This is kind of one of the main things I want you to take away. Again, we know that the 4 key components, or excuse me, the key takeaways are grain price down, cattle price up. Now in general, what can we do to protect those trends for ourselves? So the first tool I want to draw your attention to is livestock risk protection. This is not a new tool, but it is a newly popular tool here on the Texas High Plains in particular. People in the north have used this for a long time. But livestock risk protection is essentially a subsidized put option. So what this does is it is price insurance. This is subsidized price insurance. So what it does is it basically you are allowed to look at the board. Your LRP contract is tied to the board. You lock in a price, hopefully one that's favorable for you. I hope you're not locking in bad prices, but you're locking in a price that's favorable to you. And over time, if the price that you deliver at, or the price on the day of delivery for this contract, is below what you insured, you are issued an indemnity for the difference between the two. Now I'll tell you, economically speaking, in any government program that is subsidized, we expect that over time your economic benefit is the subsidy. Any insurance product over time, if you use it in the same fashion every year, we expect you to earn the subsidy. And the subsidy for this program has increased significantly in the last 2 years. There's some advantages to this. Does anybody price using options? Is anyone comfortable telling me does anyone price using options? We got at least one. So some advantages to this. There are disadvantages to this program, absolutely. One of them being that the option can be executed at any time. LRP contract is day of, and so you could suffer from a market spike on the day of delivery and you not be issued an indemnity even though you didn't deliver your cattle on that day. But in general, the benefits to me for LRP typically outweigh the cost, particularly if you're a smaller producer. Some advantages, as opposed to having to use an option that is the full amount, so the full pounds, you can insure as few as 1 head. There are adjustments for different animal type. So if you've got calves with ear, if you've got heifers, there are adjustments in terms of what you have to pay and what your premiums are, so it's more appropriately adjusted for risk management for those individual animals. And it's more competitively priced after new adjustments made in 2020 and 2021. In general, this is going to be cheaper than an options contract, both on a per pound basis as well as a total value, because you can insure exactly the number of head you have. You're not going to be overinsured or underinsured, which sometimes an option will leave you with overinsurance or underinsurance. Another thing to think about, who uses PRF insurance? Does anybody in here use PRF? Comfortable telling me? Okay, PRF insurance, this is our rainfall insurance tool. What we find is that west of Abilene, on average, where we've tested this, on average it sends $2 to $3 in premium back for every $2 to $3 in indemnity back for every $1 invested in the program. Now you will inevitably write a check for this program and lose some money on it. But risk management is not about hitting a home run every year. It's about sustained returns that mitigate severe losses. So this program over time will on average lend you $2 to $3 in return for every dollar you invest. Basically how it works, we have a historic rainfall amount that you can insure against at whatever percentage you're comfortable with, 90% all the way down to I think 70%. And if you get less than the insured amount of rainfall, you're issued an indemnity. What I like about both of these programs is that they've become more and more friendly in terms of not having to extend any cost to yourself unless the program doesn't pay. And so what I mean by that is PRF, for example, you sign up in December now, you don't have to pay anything when you sign up. If we get around to, I think it's July, and it looks like you're not going to be issued an indemnity, you pay then. But the benefit of that being, if you have to pay back on your insurance program, that means that we probably got some rain, right? So again, risk management being, we don't want to hit a home run on this program every year. If we have to pay for our insurance program, hopefully that means it rained a lot and you have fat cows and this really isn't going to be all that important to you. In general, we expect this to be a very positive return from PRF over time. Both of these programs, both PRF and LRP, you can find through a licensed crop insurance provider, so the same people that provide your typical historic crop insurance for corn, wheat, sorghum, those kinds of programs. Other risk management tools, these are disaster mitigation. So LFP, our livestock forage program, unfortunately we just passed the deadline on LFP at the end of January, but for your consideration in the upcoming year, LFP is just an indemnity. You don't have to pay anything, there's no premiums. You prove a loss based on drought circumstances, and I'll show you what the map looks like on the next slide, but you prove that you suffered a loss, in some cases only in production. It doesn't have to be a death loss, right? You can insure or you get indemnity for loss of production. It's based on a combination of different factors, including duration of drought and severity of drought. But for 2022, basically, if you lost a month of grazing based on how bad the drought was, every month you lost, every cow you owned was issued a $50, $47.29, but let's just call it 50 because that math's easier for me, $50 per head payment. It's not going to make you whole by any means, but it's going to mitigate some of those severe disasters, at least some. How do they factor whether or not you suffered losses? These are the monthly maps that exist for a variety of crops. This is our native pasture map, and what you look at again is how many months are eligible. And when it says months, the USDA is talking about grazing months based on how much forage we lost in terms of productive forage. And so we think about this part of the country. The last year we were eligible for 5 months. We think about how many cows we have. Let's just, again, please for my sake, keep it at $50 per head. Times 5 months, that's $250 per head for your 2022 payment. Again, it's not going to make you whole by any means, but it's going to buy you some hay, help mitigate some of these severe drought losses. It's updated monthly. You can sign up for it any time, but the deadline is always January 31st of the following year. So we just passed the deadline for last year's program. But this is like those left-handed scholarships that nobody applies for. If you don't apply for them, if you don't go fill out your paperwork, that money's just gone. But if you go apply for it, most of our FSA offices follow this. Now, I'll say one key consideration that's been brought to our attention in the very recent future. This is the livestock forage program. You have to have interest in livestock and or forage. There's a mix there where if you lease by the head, the owner of the forage doesn't have interest in the cattle, and the owner of the cattle doesn't technically have interest in the forage. So if you lease by the head rather than by the acre, you are not eligible for this program. It's something to discuss with your landowner if you lease, or your tenant if you're the leaser, because you're both leaving money on the table for a free program. And I know a lot of us are used to leasing by the head, and if we are, you can get that bundled into the right dollar amount on the per acre price. But if you don't have it on a per acre basis where you both have interest in each entity, you're not eligible for this program. We're going to try to get that fixed in the next farm bill, but as it stands, this is where it's at. So I've thrown a lot of information at you, and it's before 10 a.m. I try to not do economics before 10 a.m., but here we find ourselves. So decision-making tools that will help you with all this information. We've got beef cattle decision tools at the Agricultural Economics website. So this is our website here, aggiecoextension.tamu.edu, et cetera, et cetera, et cetera. Decision aids/beef. You can follow that website to this page. There's over 60 decision tools that are hosted there that help you in making a ton of management decisions. If you're not comfortable with using spreadsheets, you can call me, you can call your other extension economists, and we would love to help you fill these tools out wherever possible. You can interact a lot of these spreadsheets and use them in combination. Again, remember I was thinking about whether or not we want to retain ownership and what to do with the grass we have if we don't keep calves on pasture, or what if we do keep those calves on pasture to a heavier weight. Many of these tools will help you evaluate those decisions. So they're super useful, and I'm always, like I said, I'm an over planner, and I would just tell you that it's better to plan for the worst case outcome and react to the best case rather than the opposite. And we've got a lot of tools that'll help you do that. That's what I have for you this morning. I appreciate your time. This is where you can find my information. I know I've covered a lot this morning, but I'd be happy to review any of it with you later. This is my email. This, secretly, I'll tell you, I don't really give out my cell phone number to everyone. You just never know who's going to call you these days. But that forwards directly to my cell phone. I'll do my best to get back to you, even though I owe Andy like probably 2 phone calls back at this point. One other little piece of information, or 2 other pieces of information. Myself, our district economist here in Lubbock, and our district economist in Vernon write a weekly management blog on different topics that are important to the Texas High Plains, extends to New Mexico as well. We talk about the economics of different decisions, like whether or not to retain ownership. We'll do a retained ownership update as we approach that March period when we're thinking about sale. Do some more in April, a bunch of different considerations. And then finally, this QR code, if you hold your phone up to the QR code, use the camera app. This is a daily newsletter from about 120 economists on the southern side of the United States. We write a daily newsletter that highlights different things that are important for southern agricultural producers. So there's crop topics, there's livestock topics, there are a host of trade and farm bill topics, and we really hope that you'll join us and learn about some of that. You can either go to the website every day, or there is a link here that will allow you to get this delivered to your inbox every morning. So that's my information for y'all to get in touch with me. I'll take any questions now, or I'll be around for the rest of the day too if you'd rather come chat with me in person. So, Jason, do we have time for questions? I don't even know what time we're at. Does anybody have a question or 2? Yes, sir. So the question is, have I ever looked at the difference in cost of gain from Nebraska, Kansas, Oklahoma, Texas? I've looked at them. What's your question? Yeah. You know, I'm actually going to say that's probably a better question for Jason in term. Yeah, I'm pitching. You should. So I've looked at those difference in cost, right? You're asking about, obviously our corn base is going to be a little bit higher here. So I think we're thinking about are you asking about retained ownership or just placing a lot of cattle? I mean, are we thinking about a smaller retained ownership enterprise, or we always place a lot of cattle? What are you considering? You just want to know who's the most expensive? Are we better off feeding our cattle in Nebraska, or are we better off feeding them here on the southern plains? Sure. And I'm going to give the economist answer. It's going to change from year to year. Sincerely, it really will. And I think where that's important is finding a feeder that you work well with. We were having this discussion at dinner last night. I think it's important to find a feeder who you have a good relationship with and that you can make those plans with long term, because you're going to find differences in feeders within a state as well as across states. Now, we're going to pay higher corn price down here. You're going to face some weather challenges the further north you go. So we've got to balance those genetics that you have here further south. When considering feeding north with cheaper grain, you also have to put wheels under them for a little bit further. So there's a lot of different things to think about right there. It's not just who's necessarily the most expensive, and it's probably, in my opinion, where I'm doing this, best to find a feeder that you have a good relationship with and you can work with year to year and trust. Jason, do you have anything to add to that sincerely? I mean, it's a good question. Does anyone else have any other questions? Yes, sir. Right. Yeah, you're absolutely right. And I think to Andy's point, it's a very good point, worth us all thinking about. We're going to be seeing some unique cattle prices in the next 2 years that we are all going to want to pursue. I would just remind you all to think about that additional revenue does not equal additional profit. Just because you're selling more calves does not mean you are making more profit, right? So we want to think about when we add those heifers, any really expensive heifer is pulling our other successful heifers down because of increased cost of production over the entire herd. We want to think about all those things. It's going to be tempting, but we know we've talked to many people who are still paying off their heifers from 2014 and 2015, right? So we've done some presentations on that, and Jason and I are working on a lot of that stuff for this part of the country, but it's going to be expensive to replace your animals. And all I would tell you, I'm not here to tell you what to do with your business. You all know more about your individual businesses than I do. Just things to think about. Again, additional revenue doesn't equal additional profit. That's my principle. And planning. Again, I said I'm an over planner, I'm an economist, but even if you know you're going to buy a $3,000 heifer and you know you're going to lose money on her, at least you know you're going to lose money, rather than finding that as a surprise here in the next 5 or 10 years, right? So I just put pen to paper before you go and make any of those purchase decisions. Any other questions? I appreciate y'all's time. I'll be around for the rest of the day. Thank y'all very much.
You're listening to live coverage from the